All right, let's talk about something we all do. We get paid, we deposit that paycheck, and we see the number in our bank account go up. Simple, right? But have you ever stopped to ask, where does that money actually go? It seems like a simple question, but the answer, well, it's pretty shocking, and it's going to completely change how you think about our economy. So let's dive in and uncover how it all really works.
I mean, is it just sitting in some giant vault with your name on it? Is the bank just a fancy storage unit for your cash? The short answer, nope, not even close. The long answer is way, way more interesting. And it all starts with a story. A myth, really, that pretty much all of us were taught in school.
Yeah, we all learned this really simple story about how banks work. And you know what? It makes total sense on the surface. There's just one tiny problem. It's completely 100% wrong.
So the common idea is that banks are basically just middlemen, right? You and me, we're the savers. We deposit our money, and it goes into this giant pool of cash. Then the bank takes money from that pool and lends it out to someone who wants to buy a house or start a business. It's such a neat and tidy picture, but again, it's just not how it works.
And hey, don't just take my word for it. Get this is a direct quote from the Bank of England itself. The people at the very heart of the financial system are saying, yeah, that stuff you read in economics textbooks, it's not how money is actually created today. I mean, wow, that changes everything.
So here it is, the one big idea that just flips the whole thing on its head. The myth is that banks lend out money that's already there. But the reality? Bank loans create brand new money. Let that sink in. The money isn't being moved from a saver's account to a borrower's account. It's literally being created out of thin air the second that loan is approved.
Okay, so if banks aren't just lending out our deposits, how in the world are they creating new money? Well, it's a process that some economists have this great name for, fountain pen money. Why? Because it used to happen with the stroke of an actual pen, though, today it's more like the press of a button.
Think about it like this. When a bank approves your mortgage for, say, $300,000, they don't go and check the vault to see if they have the cash. Nope. They just type the numbers into a computer and poof, a new digital deposit for $300,000 appears in your account. Right at that very moment, new money has just been pumped into the economy.
Let's just walk through it real quick. Step 1, you ask for a loan. Step 2, the bank says yes. Step 3, the bank just credits your account with the loan amount. And boom, Step 4, new money exists that didn't exist a second ago. And this isn't some weird niche thing. This is how a staggering 97%, yeah, you heard that right, 97% of all money in our modern economy is created.
So, I know what you're thinking. This sounds like some kind of magic money tree, doesn't it? Can banks just create infinite cash whenever they want? Well, not quite. There are rules. And it all comes down to this really simple but very strict balancing act. First, we gotta get a couple of terms straight. What's an asset for a bank? That loan they just gave you, that's an asset to them. Why? Because you have a legal promise to pay it back, with interest. That future stream of cash you're gonna pay them has real value, so it goes on their books as an asset. Okay, now for the other side of the coin, a liability. That's basically a debt, something you owe. And here's the part that messes with your brain a little. Your money, the deposit in your savings account, is actually a liability for the bank. It's basically an IOU from them to you. They owe you that money, and they have to give it back whenever you ask.
Now, this diagram from the Bank of England might look a little complicated at first glance, but the idea behind it is actually super simple. Just focus on this one thing. Every single time a bank creates that loan, which is an asset for them, it simultaneously creates a deposit in your account, which is a liability for them. So you have a new asset on one side of their books and a new liability of the exact same amount on the other. It's all perfectly balanced. See? It's not magic, it's just accounting.
And get this, it works in reverse too. Every time you make a payment on your loan, that money is effectively destroyed. The loan asset on the bank's books gets smaller, and the deposit liability somewhere in the system gets smaller too. The total amount of money in the economy actually shrinks. It's this constant ebb and flow. Money is created, and then it's destroyed.
All right, so if banks can just create money like this whenever they make a loan, what's to stop them from just lending like crazy and causing total chaos? That's a really important question, and it brings us to the risks and the limits that are baked right into the system.
There are basically 3 big breaks on this money creation machine. First up, profitability. A bank is a business, right? So they're only going to create money by lending it if they think they'll make a profit. Second, risk.
They have to be really careful and manage the very real danger that someone won't pay the loan back. And third, and this is the big one, monetary policy. The central bank, like the Fed, sets interest rates, and that acts as the ultimate speed limit for the whole economy.
Now, one of the biggest risks they face is something called an asset-liability time mismatch. Just think about it for a second. You can walk into your bank and demand all your deposit money back right now. That's a short-term liability for them. But their assets, things like mortgages, are paid back over 30 years. That's long-term. So what happens if a ton of people ask for their money back all at once? The bank can't just force people to pay off their 30-year mortgages overnight. That's called liquidity risk, and it's exactly what can cause a bank to fail.
And we all saw a masterclass in what happens when this risk management totally fails back in the 2008 financial crisis. Banks were making incredibly risky subprime loans. They were even making what they called ninja loans, and that stands for no income, no job or assets. Seriously. Then, through this complex process called securitization, they bundled up thousands of these terrible loans, slapped a good rating on them, and sold them to investors as if they were safe. So when people inevitably couldn't pay their mortgages, the entire house of cards just came crashing down.
So hearing all this about risk and banks failing, it naturally leads to a very personal and kind of scary question. Is my money safe? And thankfully, the answer is yes. After the really hard lessons learned from the past, we've built a pretty solid safety net.
And this number right here, this is your first and most important line of defense. In the US, this number represents a rock-solid promise from the federal government thanks to an agency called the FDIC.
What it means is pretty simple. If your bank goes under, your money is insured by the government up to $250,000. It's an automatic safety net. And get this, since this whole system was created way back in 1933, not a single depositor has ever lost 1 penny of their insured money. That's a pretty good track record.
You know, the fallout from 2008 also sparked a lot of new ideas. We're now seeing the rise of things like ethical banks, which try to use their money creation power to fund positive social or environmental projects. And then, way on the other end of the spectrum, you have decentralized finance, or DeFi. That's the whole world of crypto and blockchain trying to build a new financial system from scratch, one that doesn't need traditional banks at all.
And all of this really brings us to the biggest question of all. Now that we know that private commercial banks create almost all of the money in our economy, what should we demand from them? Is it okay that this incredible power is used mainly just for profit? Or should it be directed toward creating a better society for a greater good? The answer to that question, well, that's what's going to define the economy of the future.